Hello everyone, this is Professor Kent. Today's recording is chapter 4, and chapter 4 is called Cost, Volume and Profit. The relationship between the cost, volume and profit. When we think of a cost, volume, profit is a powerful tool. Who is it used by? It's used by managers. What do they do with it? To help them understand the interrelationship among cost, volume, and a profit in an organization. When we think of a cost, volume, profit, there's a five component that we needed to look at it. Now, prices of the product. So that will be it will be called a selling price or a sale price is also is okay. So sale price, selling price, same thing. Volume or level of activity. Volume will be how many products did we sell, number, quantity. That's what it is, a quantity. Per unit variable cost to produce, cost to produce one unit or one product, or cost to buy one product. So cost to make one product or cost to buy one product. So it's a variable cost. Fixed cost is the total fixed cost, mix of products sold. We could be selling product A or product B depending on the mix of those products that are sold. Going further, if you look at it, this is the basic that you have seen, and we call a contribution income statement. What is there? You have to separate your variable and your fixed. So sales minus your variable expense equal to your contribution margin minus your fixed expenses are equal to your net operating income. So when we think of a contribution margin, this is your margin, means you're buying it or you're making it. This is what your margin is for if you sold 500 units, your margin on those 500 units will be 100,000. Now what happens is that before we get to it, we needed to calculate the contribution margin per unit and a percentage of contribution margin in a form of percentage. So how do we calculate it? It could be shown as a unit or it could be shown as a sales. Now if I were to think about it, if my total sales is 250,000, I sold 500 unit, what is the per unit cost? You take your 250,000 divided by 500 units that you sold, 500 units that you sold. The cost per unit is $500. The selling price per unit is 500. If my variable expenses are 100, total variable expenses are 150,000 divided by the 500 units, that gives me per unit cost. So again, your sale price minus your variable price or variable cost is equal to your contribution margin. And then when we talk about a ratio, they set your percentage of sales. So sales are always 100%. So if they're 100%, you have to find out what percent is my variable expense and what percent is my contribution margin. So in this case, if I take the 500 divided by the 500, gives you 100%. That's where your sales come from. Your 300 divided by 500 gives you 60%. Your variable expense are 60%, and your contribution margin will be 200 divided by the 500, which is your 40%. So what happens is, what is this telling us? Every additional one unit sold, we are going to generate $200 per unit. Our margin will be $200 per unit. So I already talked about it, how we calculate the 400. Now your fixed expenses, when we say that the fixed expenses, they stays the same. So what word here is break even. break even is how many units do we have to sell to recover the fixed expenses and to recover the variable expense. We don't want to make any money, so that's what it is. Break even can be represented in units, or it could be also represented in a dollar value. So think break even is how many units do we have to sell to make no profit. We only recover the 120,000 and the 800 at the 80,000. So we have to sell 400 unit to make nothing, to break even. So if you look at the question here, when we sold 500 units, we made some money. So if we don't want to make any money, what we wanted to do is we wanted to break even. We have to, as a company, we have to sell 400 units in order to break even. Now there is a farm every the other thing is, the next one is that when you if you sell one extra unit, what you're going to do is you're going to make $200. So that's your margin is. So if you sold 2 units, extra units, then 2 times the 200, which is your 400. So every time we're increasing a unit, we multiply by the our contribution margin. This will be the impact on your operating income. Now, this is saying we don't want to prepare, you do not need to prepare an income statement. And we wanted to know, um, so we want to know, and we wanted to estimate the profit at a particular sales volume. So how do we do that? In this case, they told us that if we sold 430,000, the net operating income will be 600. Can we prove it? The net income will be 600. We know that our break even was 400 units. We did not make any money. So we wanted to sell 430 units. So the difference in the unit is $330. 30 units multiply by our contribution margin per unit, and that gives you 6,000. So your operating income will increase by 6,000. If you sell an additional 30 units, the contribution margin per unit is 20. Now if you were to do that, they said that now this is just to show you the relationship. If we sell 300 units, if we sell 400 units, and if we sell 500 units, what happens is, if you sell at 4 even, we don't make any. If you sell less, we're going to lose money. If you sell more, then we're going to make some money. And they said, how do we calculate contribution margin? Again, you could take a dollar value to calculate it, or you could do a dollar value to calculate the contribution margin ratio, or you could do a per unit. So my selling price was your selling price was 500 and my contribution margin was 200. If I take 200 divided by 500, that's price per unit. We can say per unit, take it per unit cost, or per unit contribution margin, or we can take a total contribution margin. It will give you 40%. What does that mean? Each $1 increase in sales, we will make 40 cents. So in other words, your sale is 100%, which is a dollar. Every dollar increase in sales will give us a margin of 40 cents. How did we get it? $1 is my sales multiplied by my 40 cents, give you the 40 cents that we need. Now this is I already done it. I didn't know I had a slide for that. Now what happens is that when we without working out the income statement, can we do this? If sale is increased from 400 to 500, so what is my increase? My increase is 100. So they said my contribution margin is 200 per unit. My contribution margin will increase by $20,000. So that's what it means. So the other way to do is you could take your the change in in the sales volume, which is dollar value is 50,000. I multiply by the 40% and I get a $20,000. The effect of the change, if you want the change in contribution margin in dollars, you take the ratio times the sales revenue in a dollar value. Going further now, let's do a reference check that if we're able to do that. They said that what is the contribution margin ratio. We're looking for a ratio. So what we needed to do is, we know the selling price is at the bottom and contribution margin is at the top. So how do we calculate the contribution margin? We have a selling price which is $1.49. My variable expenses are 0.36 and gives me a contribution margin, and I believe the contribution margin will be $1.03. How do we get it? Your variable expense minus your contribution margin will give you variable expense give you a contribution margin that will be 5, maybe 105. So use your calculator to work out the numbers. I am trying to find my calculator so I can get the number. So in this case, what will be my I'm just trying to, so that will be my sorry, my something happened to my, I closed the window accidentally, so I'm just gonna go back and calculate it. So that was my 113. Sorry, I can't do a simple calculation. So if I were to go this, so you have your sale price minus your variable expense will give me not 105, $13 divided by your selling price, which is 114. My answer is contribution ratio is 0.758, or it can be, you can take the 0.758 multiply by the 100 to get your 75.8%. Now this is shown in a fraction. If it's shown in a fraction, we do not need to multiply it. And how do we calculate the variable expense ratio? Again, we're doing, what is my variable expense? My variable expense is 36 cents. What is my selling price? My selling price is 49, and that's how we get the ratio. So that's what we're going to do. So sales minus your variable expense divided by the sales. It can be shown in a unit. If they're looking for variable expense per unit, it will be that. And we could also show in a form of percentage. So if you do a percentage, you do a multiply by the 100 to get my variable expense ratio is your variable expense divided by the sales. So I have, it can be per unit or it could be in a percentage, and this is the contribution margin ratio. Contribution margin also can come up with the sales are always equal to 100 or 1 minus the variable expense divided by the sales. Now we said the fixed cost stays the same, it does not change. So either we sell Now, sometimes what happens is if we're in the relevant range, the fixed expense does not change. But then sometimes the fixed expense changes. When do they change? When they tell you in the question, say, what is the profit impact if the sales increase from 500 to 40,000? My sales was 500 originally. Now my sales are 540. There's a change in my sales unit, which is 40. And if I take the 40 and multiply by the contribution margin, that's my first change, and it is an increase. Then they said that uh, and the monthly advertising budget is increased. So you also have your fixed expense that also increased by $10,000. So you wanted to know what is the impact on my operating income or my net income. So in this case, they don't want you to work it out. So in this case, I will be adding the both numbers. My overall change in my operating income um, will be 18,000. So sorry, I just put another zero here. So 1 2 3 1 2 3. So the overall change on your operating income will be 8,000. So when you do that, if you look at it, this is what the it is increase. Sorry, if it's an increase, it will reduce my mistake. It will reduce my operating income. It will not increase it. It will reduce it because your expenses went up. It will reduce your operating income. So when you think of it, my my fixed expenses was 80,000. It increased by 10,000. My fixed expenses are now a $90,000. So if I rework it out this way, I will have a change in my operating income of $2,000, and your operating income will go down. So we could do it in a form of doing an income statement, or we could show you in a form of a shorter way to do that. Now, if there's a change in variable costs and sales volume, what is the impact on my profit and my operating income? So the next part of the question is, there's a change in variable cost and change in sales volume. What will be the impact on profit if variable cost change and sales volume change without doing the income statement? So what you could do is now do it in a way what is happening. What is the profit impact if higher quality of raw material is thus increasing the variable cost per unit by $10? So our sale was 500 units. Now the sale is 80 units is increased. So we had 500 units before. The variable cost is changed by $10. So change in variable cost is 5,000. Is it in what would that have? It's the cost increase. The impact on it will reduce your operating income. So it will reduce your operating income when the variable costs are if variable costs or fixed costs are changed. So now if I were to look at it, they said now our original contribution margin was 200. Because of the variable change, our contribution margin will decrease by 10. So my new variable cost will be $190 per unit, and the change from the old to new, the volume change is 80. And in this case there's an increase in volume, means we're going to have more contribution margin. So 190 times the 80 will give you an increase in my operating income of 15,200. Altogether the overall change will be 10,200, and it'll be a positive change. So now work it out the numbers at 500. You multiply 500 with price per unit, which is 500. My variable cost, if before it was 200, and now it is what they asked us to be. So in this case, they said our original the original was $200 before, and now the cost is $190 times the 580, and then we sold 580 units, and then the cost is selling price is 500. So and my fix did not change, so this is 200 times the 500 units. So you could work it out the income statement way, or you could do a shortcut and then you'll get the same answer as you got before. Going further now, there's a change in fixed cost and change in selling price and sales volume. So there's a lot of changes that are going on. So we have to, either you do it the income statement way or you do it the shortcut way. So let's do the shortcut way, saying what is the profit impact if selling price is cut, means went down. So we already, what did we do? We decrease our selling price. If you decrease your selling price, it will also decrease your operating profit. How many units we had? We have 500 units, and we decreased the cost. 500 units was our break even, and our cost is decreased by 20. So what happens if the cost decreases? My operating income will also decrease by $10,000. Then going further, what happens? The advertising budget increased by 15,000 per month. So what happens to it? My increase. What is an increase? Increase in advertising, which is your fix. So that is increase in my advertising. So it will reduce my operating income, so my operating income will go down. And then the next one is there's an increase. So if there's an increase in selling price, no, selling units, we sold 500 units, that's my break even. Now we have a 650, and there's an increase of 150, but the price change. So we are going to multiply by the contribution margin. Your contribution margin decrease by the 20, because if your selling price cut, and that'll decrease my contribution margin. But there's a positive impact because we sold more units. In this case, it will be a positive impact of 27,000 altogether. The impact on my operating income will be 2,000, and it's a positive. So this is what they did. Now, of course, you could do this and then work out the number. I don't want to keep doing these similar questions. What I wanted to do is I wanted to go to break even. First of all, what is a break even? Break even is when you are break even is at how many units do we have to sell in order to break even. So you want to recover your variable expenses, you want to recover your fixed expenses. We want to know how many units do we sell in order to recover both your variable expenses and fixed expenses without losing any money. So you could do it in the formula way: sales minus variable expense minus fixed gives you the profit. So, or you could do it, profit is equal P for price, Q for quantity, V for variable expense, Q for quantity, and fixed expense, where price is for selling price, Q is number of units sold. So either way, the question is going to be same. But what we needed to do is we need a formula. Break-even formula is, one could be in units. If you want to know how many units you sell, your formula will be fixed expenses divided by unit contribution margin. But if you want the break even in sales dollar, then you have to divide it by the ratio. So the ratio is in a percentage. Again, this was shown to you before, how we calculate the contribution margin ratio. You take the 200 divided by the selling price per unit, and that gives you 40%. So the formula is break even points in units. You take your fixed expenses. Fixed expenses was 880,000 and divided by your contribution margin. This will give you how many units you have to sell in order to make zero income. Or if you wanted it, you could take this, multiply by the selling price, will give you break even sales in it will give you break even sales in a dollar value. That's what it will give you, break even in the dollar value. Now going further, the example, we want to know if we are getting everything right. Of course, before we get to the next one, they're saying what is your break even unit. So when you're looking at break even units, we have a fixed expenses at the top, and if it's a unit, we're going to do contribution margin per unit. For that we need a selling price. My selling price is $1.49. My variable expense per cup is 0.36, and I know that my contribution margin per unit is $1.13. So that's my contribution margin per unit, and we want to know how many unit they have to sell to recover. So what is my fixed expense? My fixed expenses are 1,300. So when you do that, we want to know how many units do they have to sell in order to recover your variable expense and recover your fixed expenses. In this case, we will have to sell 1,150 cups of units in order to break even. So going further, what else is this break even sales in dollar? It's the same formula, but the bottom number is going to change. So that at the top we have a fixed expenses, at the bottom contribution margin in ratio. So the ratio is presented in a percentage. So I'm gonna just do it here because we already have it. So we know that this is always going to be at 100%. So I'm needed what is my variable percent and what is my contribution percent. So I need a percent. So I take 0.36 divided by 1.49. When I'm doing contribution margin, my contribution margin was 113 divided by 149. So I find out my percentage. In this case, my percentage will be my percentage is 0.758. You either take it to 4 decimal places or 3 decimal places. So then when you do the other one, it will be, I'm trying to find the formula, but I'm unable to do it on my head. I'm looking for my calculator. So 0.36 divided by 1.49 gives you 0.242. So that will equal to 100%. So then how many cups you have to sell, what will be the dollar value? So what I'm going to do is I'm going to divide it by 0.758. At the top is your 1,300, your fixed expense is 1,300. How many units do I have to sell in order to break even? 17. My sales has to be 17.15, or you could take it a break even sales, which was your 11.50, multiply by the selling price, which is your $1.49, will also give you the 17.15. So that will also give you 17.15. Going further, now what we have is we wanted to break even. Also, we wanted to make a target profit. So that's what it means. If you want to break even plus make a target profit, we're just going to add a target profit in our formula. Nothing else changes. In order to break even and make 100,000, the company has to sell 900 units. So let's see if we can do the same question that we did. We already know the answer, so in this case I'm just going to go to the answer. My fixed didn't change, but my target profit changed. They told us in the question we wanted to make a $2,500 a target profit. So 1300 plus the 2500 divided by my contribution margin per unit, I will have to sell 3,363 cups in order to break even. And sometimes the question will say profit after tax, before tax. So before tax, and if they give you profit after tax or before tax, the question is will ask you profit after tax will be if they give you tax profit before minus your taxes. How do you calculate your taxes? You have to take it 1 minus your tax rate. That's what happens, 1 minus the tax rate. This is how we do it. 1 minus the tax rate. So you take your before tax, multiply 1 minus the tax, or you can whatever the tax amount is, you take your profit, multiply by that percentage, in this case the tax profit, multiply it in order to get your taxes. The next one is just a formula you needed to remember, a margin of safety. What does it tell you? The margin of safety is excess of actual over the break even. So margin of safety, what is your safety? Your total sales, which is your actual sales, minus your break even sales. So it could be shown in a dollar value, or it could be shown in a percentage. If you ask for a dollar value, you take total sales minus break even sales. But if they tell you in a percentage, you take the margin. You have to get the margin of safety divided by your actual sales. It represent in a sale. So let's look at it and see if we could do it. They told us our break even and they told us our actual sales. So we're looking at it, margin of safety. So that's what you're looking at, is your margin of safety. So your actual sales minus your break even sales, which is your $50,000, divided by your divided by your actual sales, which is your 250,000. It gives you a percentage of 20,000. And if they ask you in a dollar value, you take that will be your 50,000 will be your margin of safety. How you get it? Difference between the actual sales minus the break-even sales is a margin of safety. Margin of safety divided by your actual sales will give you the in a percentage. Now let's see if you can calculate margin of safety and in the question that we are working out. So in this case, what is my total sales? My total sales are 2,100. My break-even sales was, we know previously worked it out, was 1,150. So my margin of safety will be 950. 950 divided by your actual sales is 2,100. Give you in a percentage. So margin of safety can be shown in units, or can be shown in a percentage. So now the next one is, what is the advantage and disadvantage of cost structures and profit stability? And then when they're looking for stability, it is, a cost structure refers to relative proportion of fixed and variable costs in an organization. Manager often have a latitude in determining their organization cost structure. So cost structures and profitability, there's advantage and disadvantage of it. If you have a high fixed cost, in this case, if you have a high fixed cost, my pen is high fixed cost or a low variable cost. In other words, what are the advantage of high fixed cost or low variable cost, or high variable cost and low fixed, one or the other, what it is. So when you're gonna have a high or low fixed cost and high variable cost, the advantage of high fixed cost is an income will be higher. So if your fixed expenses are higher, your income will be higher in the good years, and compared to the companies with a lower proportion of fixed expenses. Where the other one, if your I wanted to change it. If your fixed expenses are higher, your operating income there's an impact on my operating income. The income will also be high. If you And the disadvantage of the high fixed cost is that the income will be lower in the bad years. So one in the good years, one in the bad years. So the opposite impact. The other one is operating leverage. What does that do? It measures the sensitivity of net operating income to percentage of sales. Again, this can be shown in a leverage in times, or it can show in a number, or it can be shown in a percentage. So this is the formula. Again, you needed to memorize these formula. Contribution margin divided by your operating income, and then once you calculate the degree of leverage, you divide time, multiply by the change in sales. So again, your when you do that, your formula is contribution margin divided by your operating income. That's how you calculate your degree of leverage. And then what you're doing it, then you needed to know what is the operating leverage of 5 if sales are increased by 10%. So the percent change in your sales multiply by your operating leverage will give you the percentage increase in profit, percentage change in your profit. So this is where and again you could work it out and redo the question. In this case, what is your operating leverage? You check your answers. So this is where it is. So you have your net operating profit, and you have your contribution margin. So the top number is your contribution margin, the bottom number is your operating income, and that gives you operating leverage. You need the operating leverage to get it if there's an increase in sales, how much should the operating income will increase. So 2.21, I take the increase in sales is 20%, multiply by 2.21 will give you the change in operating, and that is 44.20%. So this was some of the things we learned. We learned a break even, which is a good one. Break even units, break even dollar value with a target profit, operating leverage, margin of safety. Those are some of the things in this chapter. Thank you so much for listening to me. Take care, and I will be recording a video on the review from chapter 1 to 4. So subscribe to my channel to watch so you are aware when my new video comes up. Thank you for listening to me. Take care, and bye for now.